All right, everyone. How's everyone doing this evening? Welcome, welcome. My name is Leroy Phillips, and I will be your presenter this evening. This evening, we'll be doing what part of the market should you trade? Right, I see Luke says I'm here. Welcome, welcome, Luke. I see Joe says looking for a gold move in the London, New York session. Nice, nice. Okay, I see people are still coming in. All right, but we're 3 minutes past the hour. Let's jump right into it. So, what part of the market should we be looking to trade? Now, are you guys familiar with the impulse and the corrective wave? You guys should be. How many of you are familiar with the impulse wave and the corrective wave? I see Joe says yes. Okay, so I assume Joe is familiar with the impulse wave and the corrective wave. I see Tesha says yes. Grace says hello. Jason says I am not. Okay, no problem. Okay, so in most cases, what we're looking for is to trade the impulsive part of the market. Now, in some cases, for example, like a case that we're looking at right now, here on the euro dollar US dollar pair, right? Here on the US dollar, euro dollar US dollar pair, you can see that we have price moving to the downside. But the price is moving kind of correctively to the downside. It's not moving very smooth to the downside. It's moving in a very corrective fashion, right? Now, the best parts of this move to the downside to be traded, and I'm speaking about this from the perspective of a day trader, where we want to get into the market around the beginning of the session. We want to get out before the end of the day, right? So that's from the perspective of a day trader, right? So this is in no means looking at it from a swing trading point of view, okay? I'm looking at it from a day trading point of view. Now, we have the price moving to the downside. As you can see, it's moving down. But what part of this market would be the best part for us to trade? How many of you have caught most of my classes? Just give me a yes if you've been here multiple times. Good, I see Grace says yes. I see the numbers are growing. That's good. Tesha says, my first one. Okay, welcome, welcome, Tesha. Luke says no. Okay, so Luke has not been here multiple times. Joe says some. All right, no problem. Okay, Jason says my first. Okay, your name looks very familiar, Jason, but okay. Evelyn says no first. Okay, Evelyn, even your name looks familiar. See, we have so many students here and so many similar names, and so many of you have the same name. All right, so in a nutshell, what you're looking for as the best part of the market to trade is the part that is most aggressive. For example, let me just bring on an arrow. So if we're looking to trade the market, we want to trade this part, the part that's trending down, okay? You want to trade the part that is trending down or the part that is trending up. Okay, now this is the stronger part of the market. So like a lot of us would refer to this as a downtrend, okay? And since we're in a downtrend, we would all want to continue trading in the direction of the trend, because as you can see, we have lower highs coming in. We have lower lows coming in as well. So this is what would be considered to be a downtrend. But I'm not sure if most of you know, but I look at this a little bit differently. Yes, I may look at this and say that this could possibly be a downtrend temporarily. The trend does not have to continue to the downside. It could change and go back to the upside. But let's look at this as a downtrend. Okay. If we're looking at this as a downtrend, what part of this market are we going to be looking at getting involved with? The best parts of the market are in the US session and the European session. So definitely that, or should I say, those are the sessions that you should be looking to get into the market at. You should not be looking to trade outside of these sessions. Okay. The Euro session and US session are the most volatile sessions of a day. So these are the sessions that are going to have the most activity, and these are the sessions that you should be looking to get involved with. Now, especially if you're looking at using instruments from the European market and US market, okay, or London and US market, or Canadian market, okay? So anything in the US session and anything in the European session, okay? So if we look at this price action, you can see that we had price trending up. Good. You can see that we had price trending to the upside. So we had price trending to the upside, and then at this area here, we had price starting to reverse. Now, with us getting this first move down, it does not mean that the price is just gonna, continue moving down or just reverse back to the upside. You gotta pay attention to the patterns that are forming. Okay. Now let us see what time this is. So right around here is around 2 a.m. Eastern Standard. This is the opening of the European session, right? So you have 2 a.m. Eastern Standard. Now, I'm looking to get into the market around this time. So between the 2 a.m. and 3 a.m. candle, I'm looking at these candles and I'm wondering to myself, which one of these candles are going to point me in the right direction? As you can see here, we have price moving to the downside. This is what we would look at and say that this is a potential trend to the downside. Okay, so if I'm looking at getting involved in the market, I'm looking to go to the downside. Okay, because the price is clearly trending to the downside. So right here on this 3 a.m. to 4 a.m. candle is where I'll be looking at getting involved. However, it is best to see a decent pullback. It is best to see a decent pullback in the market before you decide to jump into a trade. If you don't see a decent pullback, a few hours of pullback, in some cases, maybe a day or so of pullback, it would, in some cases, mean that you may not necessarily get an aggressive move in the direction of the trend. Okay, so if it's a small pullback, you could get a small move. If it's a big pullback, you can get a big move, right? So here you can see we're getting a pullback, and if we look at the time, we're looking at starting to look at our pullbacks from around 12 p.m. to around 1 a.m. Okay, Eastern Standard Time. And that would give us an idea of the off session. So when I say the off session, what I mean is it's the session that is outside of the Euro or outside of the European and the US session. Okay, that is what I would refer to as the off session. That's Tokyo, Sydney, etc. Right? So if we have 12 p.m. in this area, what we're going to be looking at is what happened between the swing that was created around 12 p.m. and 12 a.m. All right, so we're going to look at that piece of data and I like looking at it on the close of the 1 a.m. candle. Okay, so by the close of the 1 a.m. candle, I'm going to take a look at this price action and decide what direction I'd like to get involved with. Okay, so here you can see this is the swing of 12. You can see the price continued moving up. And right over in this area here, you can see this is basically 4 p.m. Eastern Standard, right? This is 4 p.m. Eastern Standard. And right here at 4 p.m. Eastern Standard, you can see that a swing was created. This is a new swing. So between 12 p.m. Eastern Standard and 4 p.m. Eastern Standard, these are the times when the price would usually stop and stall out. Between 12 a.m. between 12 p.m. Eastern Standard and 4 p.m. Eastern Standard. These are the times when price would usually stop and stall out. So us looking for a setup, it's going to have to come at the point where we find the highest swing or lowest swing of the day. Okay, so we're going to start looking at where we found the highest swing of the day, because this day started around 2 a.m. right? So right around here, you can see price went down. This is the lowest swing. Price started to go up. This is the highest swing of the day. All right. So from this area here, it could be 12 or it could be 4. Today, which is the day that we're looking at, it's 4. In other days, you could see it as 12. Okay, so you're looking at between 12 and 12. All right, so this is the time slot. Let me just box this off for you. Let me draw a box in here. I'm going to box it off. Right, so this area is the area that you'll be looking at between 12 and 12. Right, so that's the area that you're looking at. And what we're going to be doing is basically trying to create our trend line to be able to identify what is the next potential move that is possibly coming. All right, so we're looking for the next potential move that is possibly coming. So let me just remove this. And if I'm to put in a trend line, my trend line could come from right around here. This is my lowest swing. And I'm connecting it to the next swing. So we have the lowest swing, then we have the, in this case, it's a higher low, which also created a swing. And we connected these two swings to create this trend line. All right. Now, this is what we would look at and say this is more of a higher degree formation. Now, in this type of formation, we have other waves, right? Now, these other waves that are occurring do also tell a story. This wave that we just drew in here, this trend line that we just drew in here to outline this wave that we're looking at, basically tells us that this is a uptrend, and this is a short-term uptrend. Okay, so if you look at this, we would have been getting into the market around 2 a.m. Eastern Standard. Price went down. If we were looking on the sell side, we did not get much out of it. Price came back. Maybe we would have gotten out somewhere around this area or so, and price starts to go against the trend. Now, a lot of us don't like going against the trend. Me being one, I don't like going against the trend. Now, since I had this move to the downside, I would look at this and say that this is potentially going to be a correction. If it's not going to be a correction, I would be looking for a move that looks something like this. I'd be looking for something like this. I'm just going to scribble this in, okay? I'd be looking for a move up aggressively, and then we get a correction. somewhat like this. And then I'll be looking for that continuation to the upside. Okay. Now, in this case, look at what happened. We got move up, and then we got that continuation to the upside, right? So we did get a similar type of move in this case, and that would have been something that would have enticed me to go long in a situation like this, but I would not be looking forward to going long long term. I'll be looking to go long short term, because as you can see here, this was a stronger move. Okay. Now, as you guys know, we use market geometry. So anywhere around this area is where I'll be looking to bank out my profits. And then when we got this corrective move that's coming here, this is another signal telling us that we can go long. So this is also a situation that would give me that that idea that I can potentially go long. But at this time, this is going to be off session, right? So this is happening off session. Or no, it's, let me see here. Yes, it's happening off session. So all of this, most of this move up is happening off session, because as you can see here, this is 4, and everything here is happening off session. Okay. So right around this area, I kind of got a little bit confused with the time here, because this is -4, and on MT4, at least the one I'm using, it's GMT3 +3, right? So 23 hours would have been 4 o'clock. But in this case, it's 23 hours is 11 o'clock, right? So it's 11 p.m. Eastern Standard. So this is closer to midnight in this case, right? So this would have been midday, where the price stopped. And this is where it gave us a correction, pulling back until around 4 o'clock. And then price started to go up again. So all of this, what's happening here, is off session. This is part of the market that we don't usually trade. Some traders like to get involved in the Asian session, Sydney session, but this is the part of the market that I like to use to analyze and identify what we can potentially be expecting, right? So with me getting this strong move to the upside, I'd be waiting to see what type of move I'm going to get back to the downside, or is this going to continue moving up? So I'll be looking forward to a corrective move. I'd be looking forward to something like this. If it goes down, comes back, comes here, and expect it to come back to the upside. Okay, that's what I would be expecting. But clearly, as you can see, that did not play out in that manner. What we got was, we got a move down, we got a correction, and then we got a continuation to the downside. Okay, breaking out of this pattern formation that we're getting here, right? Now, with us getting this type of pattern formation, we need to make sure that we learn to draw our trend lines to be able to identify our patterns to the best of our ability. Okay, so from around here, we can project a trend line into the future, and you can see here that this would have been somewhat of some sort of expanding diagonal type formation. Okay, and this expanding type diagonal formation would have been giving us a hint that this is a bearish formation. The price would be expected to go down. Okay, so we need to learn our pattern formations. So inside of this pattern formation, this is not where you're looking to go long or to go short. In some cases, we can trade inside these corrective formations, but it is not advised that you trade, or should I say recommended, because we don't give trading advice. So it's not recommended that you trade inside of these corrective pattern formations. The idea is that you'd want to take your trade towards the end of these corrective formations. So for example, the price is moving up. When it hits the upper trend line, around that area is where you'd be looking forward to get involved, to go short, because this pattern formation would be a bearish formation. Now we can still look for hints as the price progresses. So the price came up to this area here. This is basically 11, this is 12, this is 1, right? So we're looking to draw our new trend line at around 1 a.m. Eastern Standard. So what do we have here? We have price giving us a high and it's coming down. Let me just project this out. Okay, so where is 1? This is 1. And we have these highs over here. So we would have connected these candle highs. In real time, it looked like this. Yeah. Yes. So in real time, it looks like this. So you would draw your trend line like that, and you draw another trend line connecting the lows. And you can project. Let me just bring this out so I can draw this better. Good. So this trend line now connects the lows. We don't have much price data, but it gives us an idea of what is to come. So we draw the trend line connecting the highs, we draw the trend line connecting the lows, and we project that into the future, right? So if I projected this into the future, it would look like that. And if I projected this one into the future, it would also look like this, right? So this already gave me a very good idea of what type of price action I should expect. I should expect that whenever the price comes and bounces on these lines, I should be getting some sort of reaction. It's either going to be breaking out to the upside, because this is a bullish formation. So if it's coming down like this, we could be expecting it to break out to the upside. If it does not break out to the upside, what we can expect is that once it hits the trend line, closes inside the trend line, that could be a hint that the price is not looking to break out. And you can close your trade if you're going long and get out of it. If you're going short, when it hits the trend line, closes inside, you can go short, put your stop above the current high, and you wait and see the price go in your favor. When it hits the bottom trend line, you exit again if it closes back inside of the pattern. And you can look to go in the opposite direction. For example, in this case, you can go long. If you went long, hits the top trend line, closes back inside the pattern, you exit your long. You go short, hits the bottom trend line, closes back inside the pattern, you can exit your short. Okay? In this case, since it's a bullish formation, we're looking to make sure that we get that breakout. And if we don't get that breakout to the upside, you're not going to hold on to your trade. Okay, so if you don't get a breakout to the upside, you're not going to hold on to your trade. All right, because you're looking to see if you get that breakout. Price being in a buy trade and closing above the pattern formation. So for example, this is the trend line for the pattern. It came, closed outside, above. That would be an indication that we can hold on to that long trade, because we'll be expecting price to continue moving progressively in that up direction. But once it does not close outside of the trend lines, it means that the price is potentially going to remain composed inside of the trend lines. Okay, and as you can see, these trend lines held price all the way to this level. Okay, now it is not ideal to get involved in trades inside of these patterns, right? Because these patterns could also prove to be very volatile on the inside of them. Okay, so the internal waves inside these patterns could also prove to be volatile in some cases. It is also good not to trade interest rate decisions because interest rate decisions come with huge volume. You don't want to be involved in the market in times like that. In some cases, you may see the price continue moving in one direction on a day when there is interest rate decisions. Like, for example, today we had interest rate decision for the euro dollar, and this is the early session, and this is the interest rate decision that we have here. Okay, this is not something that I would look at and say that we got a big move. This is a very small move compared to what we can see coming out of an interest rate decision. Okay, so this is fairly small, but if you look carefully, you can see that the price was coming down and it broke out of this trend. So when the price breaks out of the trend, you can see that the price made a little move to the upside, completed its wave. And if you use market geometry, you can see, let me just bring temporarily. You can see that we have pretty much a measured move, right? We have a measured move because we're using market geometry. We have a measured move. Now, with us getting this measured move and hitting the 200-point moving average, this is an indication to us that we need to get out of our trade. Okay, we're mainly looking to trade on the impulsive side of the market. Even if it means that we're trading inside of a corrective formation, we want to be trading on the impulsive side of the market. So look at this. We're looking at around here is 12. All right, so this is 12. So this is the swing around 12 o'clock. So what we're looking at is to draw trend lines. So this is a swing from around 12 o'clock. I'm not going to project this too far into the future. I can, right? But I'm not going to project it too far this time. And let's draw the trend lines on the bottom. Remember, we are drawing up until 1 a.m. So this is 1 a.m. right here. So I did do this well, good. So this is 1 a.m. and this is around 12. So the swing from around 12, this is the highest point. So this is the swing. And then we connect the upper swings and we connect the lower swings, okay? And this gives us a pattern projection. Now, what we're gonna do is try to understand what this pattern means. Now, when you do chart patterns, whether it be Elliott wave or whether it be simple chart pattern formations, it will let you know which patterns are bullish and which patterns are bearish. And as you can see here, this is what we would look at and call a bullish pattern formation, because we have an impulse and then we have this corrective pattern formation forming here. So this would mean to us that this impulse has to repeat itself at the end of this pattern formation. At what time are we looking at getting into the market? We're looking at getting into the market at 2 a.m. to 3 a.m. Eastern Standard. Okay, so this would have been our entry. We would have entered to go long. You can see price went in our favor. We can use market geometry to exit. We can use the 200-point moving average. We can use major trend lines. We can use support and resistance to get out of a trade like this. If you're using support and resistance, as you can see, if you look at the dashed lines that I have on with my crosshair, you can see this is a resistance area. Previous support turned resistance. So this is what you could look at and see is a resistance area. You can look to exit in a situation like that, especially with having confluence from the 200-point moving average and also having confluence from market geometry. So everything is telling you get out of the trade. Okay, So in a case like that, you should get out of the trade, walk away with your profits. It is not wise to hold trades into interest rate decisions. Today, it wasn't that bad. It looks like it moved pretty much in a straight line. But on other days, interest rate decisions could prove to be very, very choppy. You can have price jumping up and down, stopping you out, pulling you in, and basically just destroying your account. Okay, so you need to be very careful with these news releases. It is best that you stay away from them. Okay. Any questions so far? I see Grace says, with trend lines, are you connecting bodies or wicks or both? I draw trend lines with two fashions. And the reason why I do it like that, it's because we can have pattern variations and the market makers are tricky, right? So I like to draw the beginning of my trend line from a wick. As you can see, this is a wick. And then I connect it to another wick, which is another swing high. A lower high could be a higher high. And once I connect them, I know that that is my potential trend that is outlining my pattern, right? Or I can draw them from wick to body. So I can draw from the wick and then connect my trend line to the body of the candle that created the next swing. Okay. So as I always say, we do it wick to wick or wick to body. Okay, that's how we draw trend lines. Any other questions? Anyone else? Let me see here. Joe says, you said you get into market after 1 a.m. candle close. Is that EST time? Yes, that is Eastern Standard. 1 a.m. Eastern Standard. I'm not entering at 1 a.m. Eastern Standard. I am looking at drawing my trend lines on the close of the 1 a.m. Eastern Standard candle. Okay, I'm looking at getting involved in the market on the close of the 2 a.m. to 3 a.m. candle, right? So by the close of the 2 a.m. to 3 a.m. candle, that's where I'm looking to get involved in the market. And to give you an example, as I showed you here, this is the 2 to 3 a.m. Eastern Standard candle. And on the close of the candle being green, it says go long. And if you look at your pattern formation, it is telling you that this is a bullish pattern formation. So you're only looking for buy trades. And here you can see that price gave us this green candle at the bottom of this pattern. So we should be looking to buy this to go to the upside. Okay. And we got this lovely trade here. This was a day I did not get into the market. I did not get into the market this day. So this is not a trade that I was actually able to take because I do not trade on interest rate decision days. On those days, I just stay out of the market. Okay. So that is also something that you can practice if you'd like. Stay out of the market on interest rate decision days, whether it be European market or US market. Don't get involved on those days. Okay, those days can prove to be very, very volatile around the news release. And in a lot of cases, you do not get much movement before the news release. Okay, so it's best you just stay out. You can come back in after the news release has passed, maybe within an hour or so, you can get back in the market. But it is not a situation where I would say that it's a preferred condition. Okay, you want to stay away from situations like that. Let's see here. Let me just try to pick a random tape. Let me see what. Okay, here it's the 23rd of August. This is 12 o'clock. The price is trending up. You can see here, this is the swing that was created at around 12 o'clock. Right? Yes, this is around 12. This is the swing that was created. So this is 4 o'clock here as well. So this is our highest swing. So this is the swing that was created. Now with us finding this swing, we can now, from 1 o'clock, this is 1 o'clock right here, we can project from this swing, coming over these candles, connecting these swings together. So you're not going to good. So that is wick to wick. And we're doing the bottom. The bottom is from wick to wick as well. So you can do it in two ways. You can do wick to wick, or you can do wick to body. Okay. If we did a trend line here from wick to body, it might look like this. Let me see, where's the 1 a.m. candle? Yeah, so wick to body would look like this. And as you can see, it is still a valid trend line. As you can see, all you have outside there are wicks. Okay. The price is not closing outside of the wick to body or outside of wick to wick. Okay. Once it closes outside, it gives you a hint that there may be a breakout. All right. So here you can see this is a bullish pattern formation that is happening from around the 12 p.m. Eastern Standard Swing going until approximately the 12 a.m. Eastern Standard Swing. Okay, so this gives us an idea what we can expect into the next day. And let's see, where's 2? Okay, this is 2 a.m. Eastern Standard to 3 a.m. Eastern Standard candle. This is a red candle. It closed inside of the pattern. It did not close outside. So this was an indication for us to go short. And if we went short, we'd be able to catch a nice little trade. You can see here that it hit the 200-point moving average. Once it hits the 200-point moving average, you should exit. Okay. If it hits the trend line, closes back inside, you should exit. All right. Especially with this being a trade that is going against the pattern bias. The pattern bias is long. Now we're getting a green candle. This green candle is coming in at basically 5 to 6 a.m. Eastern Standard. We should know that this is the European sessions lunchtime. Okay, so around this time, traders are either getting into the market or getting out of the market. And if they were going long and they're getting out, the price starts to go back to the upside. So if they're getting out or if they're going long, price starts to go up. This is an area where you could also take an entry to go to the upside because price hit the bottom trend line, closed back inside. You can go long in a situation like that. Okay, so if you went long, go long, set your stopper below the low, and you hold on to your trade, see if you get a breakout. In this case, you can see here the price goes up, hits the wick to body trend line, closed inside the pattern. It gave us another candle, hit the wick to body, closed inside. It also hit wick to wick, closed inside. And then we have price basically breaking out to the upside. Okay. So this is the type of setup that if I had gotten involved with it, I would have closed my trade either here or here. One of these candles is where I would have closed my trade to the upside because I would be thinking that there is a possibility that price may not be breaking out and this pattern could be continuing to the downside. Okay. Another thing that you can use to give you a good hint that that could be a possibility is the Elliott wave theory, where you have a 3-wave correction. So this would be 1, this would be 2, this would be 3. And with us getting a full 3-wave correction, that would tell me that this corrective formation is complete. And I could hold on to my long trades. I don't have to really close them out because the long trades should be continuing because the corrective formation has already completed. So In a case where I realize that the corrective formation has already completed, I would be able to hold on to my long trade a bit longer, expecting that it would go in my favor. Okay, and with it going in my favor, I would be able to make some profit and move on to my next trading day. Any questions so far? Okay, let's see here. Joe says that was Wednesday. Interest rate decision, yes. No, today is Thursday. That was today. Today you had the interest rate decision. Okay, this morning, 7:45 a.m. I think it was 7:45 a.m. All right. Anyone with any questions? Anything you're not too clear on? All right. Okay. So take this home with you guys. One of the most important things you can do for yourself is understand chart pattern formations. One of the second most important things that you can do for yourself is know when to draw them. Okay, and where to draw them from. If you reference the swing high from around 12 p.m. Eastern Standard to the swing, whether it be a swing high or a swing low, once you reference 12 p.m. Eastern Standard to approximately 12 a.m. Eastern Standard, drawing your lines at the close of the 1 a.m. candle, it would give you a very, very, very strong idea of what type of price action you're going to expect. And if you find yourself getting a corrective formation, what you can do is, if that corrective formation is telling you to go long, you can only look for long trades, right? So you only look for long trades in a situation like that. If you're looking at using sniper entries and you have trades that are gonna trade signals that are coming in against the pattern bias, you can choose to not take those. But sniper entries is very powerful. So if you get a trade signal that is against the pattern bias and you're getting involved with that one, remember that if it hits the trend line and closes inside the trend line, you will need to exit the trade. Okay? And you can go in the opposite direction once the next candle opens. Okay? So understand how to identify your chart patterns, understand how to draw your chart patterns, and understand when to enter your trades. When you're entering your trades, it is best to use 2 to 3 a.m., which is around the market open. Use 5 to 6 a.m., 6 to 7, that is the European session lunchtime. And then you can use 8 to 9 or 9 to 10, that is the US session open. Okay, these times give you the best opportunities to get a good trade. Okay, and if you're in a corrective formation, you're looking for the next impulse, which is the next aggressive move. And that's what you really want to catch. Okay, you want to catch the next aggressive move. You want to catch the impulse wave. The impulse wave is where the bulk of the money is in the markets. All right. Any questions, guys? I see someone sent something in the Q&A. Can I say, oh, say the times again. Okay. Oh, can I say those times again? You're looking at 2 to 3 a.m. Eastern Standard to get involved in the market. That is the beginning of the European session. That's, if you're looking at the candles, it's the 2 to 3 a.m. candle. and 3 to 4 a.m. candle. Those are the two that you're looking at to give you an idea if you should get in or not. Then you're looking at 5 to 6 and 6 to 7 a.m. Eastern Standard candles. That is the lunchtime for the European market session. That is also a time that you can use to look for an entry. You can also use the 8 to 9 and 9 to 10 a.m. Eastern Standard candles. These are the times when the US session opens. Okay, so that's 8 to 9 or 9 to 10 candle. That's where the US session opens. So if you take advantage of these times, it would give you an advantage in the market. Okay, let me see here. Joe says, okay, thanks, Leroy. Very awesome. Okay. Okay, before you end the webinar, could you show your DXY chart analysis? Okay, you want to see my DXY analysis. Okay, no problem. Okay. I forget. Oh, you love DXY? Okay. Okay, I've been getting better at swinging. Any rules or advice for trading stops and how to close? Okay, rules and advice for trailing stops and how to get out of a trade. Okay, I've done classes on market geometry, so you can go back into the vault and look for the classes done on market geometry. That will give you a very good idea of when to exit and how to project your profit targets. So that will give you profit projections and exits. Okay, market geometry. You can use the 200-point moving average if you're in a long trade and price goes and hits the 200-point moving average. That is also an area where you should be looking at exiting your trade. You can use support and resistance, but I'm sure that you already know that. You can use support and resistance as a reason to exit your trade as well. You can use the Elliott wave count along with market geometry so that you can have an idea when your wave would end and potentially maybe reverse or go into correction. So that's pretty much the techniques that you can use for exits and in some cases entries as well. If you're looking at trailing stops, one of the most effective ways that I have found to trail stops is basically like this. Let's say I entered here, I go long, I got this candle close. When this candle closes, right, I will be preparing to trail my stop when the next one opens. So when this candle opens, I'll move my stop from down here. And I'll bring my stop here because this candle is closed. So remember that. This is my entry candle. When the next candle closes, I'm going to move my stop from below here and I'll bring it behind the next candle because this candle is closed. It will be acting as to some extent, a barricade for price. So I'll bring my stop below that candle. When the next one closes and the next one opens, I could bring my stop up behind this candle, which is the current one, behind this one. When this candle closes and the next one opens, I could bring my stop behind this one. Okay. In a case like that, you can see here that price moved down aggressively. It looks like it did not reach where we potentially placed our stop and price continued moving up. Now, if you're using exit techniques, like for example, if you're using support and resistance, let's just see here. We may have a support line or resistance line, I should say, in this area. Let's go back. As you can see, yes, there is one in this area. If you want to draw a zone, it would be from maybe this area here to this one, and that would be a nice zone. Let's see. Yeah, so this would make a nice zone, as you can see here. Would make a nice zone. Once price hits that zone, you exit. Okay, so that's support and resistance. If you're using the Elliott wave, if you're using the Elliott wave count, you got 1, 2, 3, 4, 5. What you can do is you can measure wave 1, because wave 1 and wave 5 generally share a relationship, and you can project that length of wave 1 for wave 5, as you can see here. See that? It's pretty much identical. Try to get it as close as possible. As you can see, it's the exact length. Okay, so once you get that measurement, you exit the market, you're done. Okay, you look for the next direction, because after this 5-wave move, you're looking for a ABC correction, which is a pullback. So with you getting this 1, 2, 3, it's a little bit more complex than that, but you basically got this corrective formation, right? After that corrective formation, you're looking to go long again. If you're trading inside the corrective formation, you got to be very careful. You got to know what you're doing. Remember, if the price hits the trend line, actually, let me just try to do that one for you. Let's see, what time is it? This is 12. So this is the 12 p.m. swing. And we're looking at 1, right? On the close of the 1. So I'm going to take my trend line from 12 and I'll project it into the future like that. This is, where is 1? So this is 1 a.m. Eastern Standard here, but we have a lower high. Okay, so since this is a lower high, price is trending down now. This is a lower high. I can't bring the trend line to 1 like that. I can't do that. It has to stay on the lower high. Okay, and everything else in here is part of this pattern formation. And I do it for the bottom as well, from swing to swing. Connect this swing to this swing. And this is what I got. This is my pattern formation. Okay, and let's see, this is 1, this is 2. If I'm using market geometry and I get this sell signal here, it hits this 200-point moving average, doesn't break it. That's another reason for me to look to exit. Closes back above it, so it's rejecting, so I'd exit. This is my pattern formation. It's a bullish pattern. If I went long, as you can see, price hits the upper trend line, it closes back inside. That I could use as a signal to get out of the trade as well. If it's a case where the price was very aggressive, as you can see here, I would not, be very excited to get out because it's very aggressive. But as you can see, we got this red bar closing back inside. So that's another signal telling us that price potentially wants to continue going down or go into correction. So if it goes into correction, you have another opportunity to get involved in the trade. So I'd exit with my profit and then look for my next entry. Okay. So you can see price went all the way back, hits the 200-point moving average again. Another reason for us to exit when price closes back above and actually bounces off this moving average. If we went long at that time, you can see that we went long and price broke out to the upside. Okay. Any questions? I see Grace says, appreciate your trainings. Thank you. You're most welcome, Grace. Most welcome. Mark says, good stuff. Joe says, oh, wow. Very great stuff. You're most welcome, guys. Most welcome. Okay, guys. Well, this will bring us to the end of this evening's class. Thank you so much for coming. It's been a pleasure having you as usual. Bye-bye for now. I'll see you guys next time. Bye.